Hi everyone, it's Jamie Kertis with Grinkmeyer Leonard Financial, and today I'm bringing you an update to the CARES Act. So originally passed back in March, over the last several weeks we've gotten some clarifications on how the CARES Act is to be applied to you and to your participants. So I just wanted to review those briefly with you and make sure that you were up to speed on all the recent developments. So the first clarification came in the way of who is actually a qualified individual relating to your 401k plan. So initially it had to be your employee who was qualified by either being diagnosed with COVID-19, having a dependent or spouse diagnosed, or facing financial hardship due to COVID. The clarification in Notice 2050 comes that now it can be a spouse or dependent or other member of the family that shares the principal residence who now can become qualified under your plan. So the easiest way to think about this is if you have an employee whose spouse loses a job, your employee now can come and make a CRD, a COVID-related distribution from your plan, even though he or she is not the one who has been financially impacted. So that's a pretty significant clarification. Now allowing, like I said, not only your employees to take distributions, but also one of those dependent members of their family. Regarding these loans, there wasn't too much here. We kind of assumed that loans could be self-certified from a needs basis, but then Update 2050 did go ahead and confirm that you as a plan sponsor do not have to verify the need of your employee, that self-certification is sufficient enough to take one of these COVID loans. There was no extension of the timing on these, so again, COVID loans right now are scheduled to only be allowed through the end of September, but we may get some further clarification on that in the weeks to come. Regarding withdrawals, again, not a whole lot here. There was some specific examples given of how that amount can be paid back into a plan over a 3-year period. There were also some examples on how the taxes can be paid. So no changes to that 3-year payback or that 3-year extension of the taxation, just more showing that, again, if someone took, let's say, a $9,000 COVID withdrawal, he or she could extend the taxes for $3,000 for a 3-year period and only pay on those amounts. Regarding required minimum distributions, the rule of thumb was pretty much for 2020, RMDs didn't exist. So there was no requirement to take one. There's no additional responsibility in subsequent years. And clarification or Notice 2051 really clarified that individuals who did take an RMD prior to the CARES Act being passed, so in January or February of this year, have until August 31st to repay that money back into their qualified plan. Again, this doesn't count against any of their 402G limits. This is just a repayment. So again, if you have somebody who took a required minimum distribution for 2020 in January or February, they do have some time to repay that. I think that's going to be fairly rare because most RMDs are taken at the end of the year, but do just be aware of that. And then regarding tax codes, I don't want to spend a whole lot of time here because this is not our area of expertise, but there was some clarification that for 1099 reporting, you will most likely want to indicate code 2 in box 7, which just indicates that there was an exception to the distribution rule, and the exception, of course, being this is a COVID distribution or a CRD. And then this final bullet point about participants claiming a COVID-related distribution, a CRD, even though the plan does not report it as such, speaks to more personal taxation. So again, if someone pretty much has taken a distribution at any point this year, they're gonna more than likely wanna claim that as a COVID-related distribution, even if your plan didn't mark it as such. And the idea here is that the CARES Act really was passed as an immediate relief for all of us impacted in this way. And so there's not really any anticipation that the IRS is going to personally audit on these CRDs. So like I said, you as a plan sponsor, not responsible for certifying these, not responsible for how your participant reports them. But again, there was some clarification that participants will probably just want to report them as COVID related on their own personal tax returns. Regarding safe harbor, so this is only going to be applicable to you if your plan currently uses a safe harbor match or a safe harbor non-elective contribution to pass non-elective testing. There was some clarification that states starting March 23rd through the remainder of this year, you can terminate or reduce or suspend your safe harbor contributions without having to prove economic hardship and without having that maybe not language in your safe harbor notice. So what the maybe not language states is that when you deliver your notices for the next year, so in November or December of 2019, when you gave your safe harbor notice for 2020, There are some instances where you may want to include language that states you may opt out as a plan sponsor of your safe harbor obligations. What this notice 2052 clarified was that you didn't have to include that language for this year, and you can still go ahead and suspend or reduce your safe harbor responsibilities. And again, August 31st seems to be the date that they've kind of pinned to make any of these changes. Now, there are a lot of words on this slide. I'm not going to go over all of them, but I did want to bring back up the Families First Coronavirus Response Act. We talked about this previously in regards to the fact that if you have someone take advantage of this extended FMLA, that their pay could still be subject to deferrals and then to match. Why I put this back up here today was that if you find yourself in the same boat that I find myself, where your child's school may not be going back to normal schooling in the fall, there are still some ways that your employees may take advantage of this extended FMLA. One point I do want to mention here is that it looks like if someone took advantage of this in the spring when schools closed, they may have already used some of this extended leave. So it makes 10 weeks of additional pay available, but if you had an employee that say already take 4 of those weeks in the spring, he or she may only have 6 weeks left. So this gets fairly complicated, and if you want to talk about this in more detail, please contact me, but do be aware that this extended FMLA will persist through the fall, and if you find yourself having employees who are impacted by school closings, you may need to be aware of this. As always, our team is here to support you in these ever-changing conditions. We are certainly doing our best to stay abreast of all the changes and how they impact you. We are here to serve you, our plan sponsors, and your participants. So if you find that you need any additional clarification on what we talked about today or anything else, please don't hesitate to reach out. Again, I'm so looking forward to when we can be back in-person meeting and doing more interpersonal interactions. But until then, please continue to use this for a resource and let me know if there's anything else we can do for you. Thank you and have a great day.